Hello, and welcome to our post election edition of Five Things Investors Need to Know This Month. The question of the week is: has the election changed everything, or has the election changed anything? My name is Valerie Leonard, CEO and founder of EverThrive, and clearly investors have a lot of questions about what we can expect during this presidential transition and beyond. So today I want to try to tackle some of the top questions I'm getting here in our top five things you need to know this month. So, first of all, just know that right after the election, markets responded pretty much as we would have expected from a Republican majority. We saw US large cap stocks, we saw small cap stocks, and even bond yields, which are illustrated here on this chart on the left. We saw all of those move sharply higher immediately following the election results. From a sector perspective, healthcare and REITs have struggled the most, and we've seen financial and consumer discretionary sectors basically go vertical as part of the what the media has deemed the quote unquote Trump trade. So overall volatility has decreased significantly, which potentially signals higher growth. Now, of course, these are very, very short term results. And a key takeaway for investors is that the markets are responding more to what I think is the pro growth and deregulation policies on the table now, rather than the potential risks from tariffs or increased deficits, which we'll talk about in a minute. If deficits were the market's concern, the US dollar and also the stock market would likely be weakening as bond yields have risen. And that's not what we've seen. Now, instead, this chart shows how the US dollar is breaking out in addition to rising bond yields. And this generally signals that inflation is reaccelerating. I know that's not great news for, for us as Americans when it comes to our, wallets, but markets are trying to price in potential future growth. Right now, the S&P 500 and Bitcoin have a positive 80% correlation, which just basically means that they're moving in tandem together. So when one goes up, the other goes up, and then vice versa. We're watching gold closely. While the trend still appears to be bullish, it has pulled back in the short run. And the correlation between the US dollar and gold is an inverse correlation of negative 84%, meaning they move opposite each other. So just something to watch. Third, from a business standpoint, we're watching the news on tariffs and taxes closely. I'm pretty sure that it's likely we'll spend all of 2025 talking about tax policy. Republicans, of course, want to extend Trump era tax cuts permanently, but keep in mind that both tariffs and tax cuts can boost inflationary pressure in different ways. Currently, the annual inflation rate hit 2.6% in October, which was in line with expectations. And then the Federal Reserve announced a quarter percentage point rate cut this month. Fed Reserve Chairman Jerome Powell has said that the results of the election would have no near term impact on U.S. monetary policy. But of course, it remains to be seen what will happen in the long run. Fourth, looking ahead, many of the policy decisions and the degree to which Trump's campaign promises can be executed are largely going to be determined based off of the personnel choices he makes. And we've had a lot of news on that in the last few days. Elon Musk has been a central figure in Trump's campaign and is continuing to play a role in his administration. Now, while it's very unlikely that he'll have the ability to cut 80% of federal staff as he did with Twitter employees, there will definitely be shakeups and some personnel cuts. Ultimately, from a political standpoint, President elect Trump has 2 years to accomplish his agenda, since he likely fears a changing of the guards in Congress in 2026. And at the end of the day, he's pro growth. He's an advocate for deregulation, which businesses generally like. So we'll be keeping a close eye on what his policy and personnel decisions may mean for your money. So, what may lie ahead? Let's take a quick look at a chart that we shared last month, because it's an important reminder that elections tend to increase volatility, but then markets historically normalize after the election. So, in other words, election outcomes don't drive market returns over the long run. If you go all the way back to 1950, there have been 18 presidential elections. There have been 10 transitions in the White House between Democrats and Republicans. And over those 74 years, US GDP growth has actually averaged a 3.2% annual pace, whereas the S&P 500 has compounded at 9.4% a year, according to JP Morgan. So, as always, I encourage you to avoid investing with your feelings. If those emotions are positive, if they're negative, regardless of how you feel, just keep your focus on your long term strategy. Thank you for watching this month. I hope you'll join us next month for more. Don't forget to click the subscribe button to be notified of our next video, and we will see you soon.